So when we switch to the U.S., and we're going to talk a lot about rates, kind of where this inflationary pressure goes, we just want to kick off on the everyone knows my favorite dashboard coming from the Atlanta Fed, just to show how elevated we are from what the target is. So the everything red is a measure is more than 50 basis points above target. So when you look at where we are right now, we're 50 basis points, at least 50 basis points, I should say, above what the target rate is, which is about 2%. So the last thing to cross that line was that Dallas trimmed mean PCE, but the core PCE, core CPI, all of these have already continued to move higher. And I think the biggest issue when you're looking at this is obviously it's here. We've talked about it. We've called for it. Now that it's here, now that we know it's happening, we know we're getting Fed funds increases. We know we're getting a cut to QE. Where are the impacts going to be seen? When are we going to start to see this go from, let's call it red to yellow? When are we going to start to see some of the hard work coming? And where? So when we look at the inflation's breadth, I think this is so important, and I think this is a great chart that is coming from the U.S. Department of Labor and Wells Fargo. But I think this is fascinating because when you look at things that are increasing by 5%, is 47%. So when you look at that push and how quickly that happened, that doesn't adjust all that fast. And that's when you look at we went down this steep slope. We had this massive acceleration, and now our view is that it's the rate of change has to slow. I mean, look at that chart. Look at it was literally a boulder flying down the side of a mountain, and here we are. So now the pace is going to slow. Now you're going to start to see, and this is where we talk about that sticky versus that flexible, because this is going to lead into that sticky inflation that we've been discussing. And that's why the breadth becomes such a problem, because if someone is saying, well, it's all energy or it's all housing, well, this is just showing you that's not the case. This is showing that it's a broad sweep of price increases. It's a broad, stroke of issues. And yes, I'm not saying that energy coming down won't be better, because you'll take gasoline with it, heating oil, diesel, all some of these key pieces. But based on where current WTI prices are, it's not happening now. You're starting to see an increase again in prices, especially as things remain fairly cold on the East Coast, especially New England, where a lot of heating oil is consumed, which is, as we've said many times, is essentially road diesel. That's going to keep that competition for diesel on the road, as well as prices into the home. But when you're looking at just the breadth of the issue, well, what are CEOs expecting? What are we seeing on the C-suite side? So the outlook from the conference board, inflation concerns soaring, and last year's survey, inflation barely registered on CEOs' radar, ranking 22nd on the list of worries. In 2022, it's rocketed to number 2. What's more, 55% expect high inflation to last into 2023 or beyond. Now, these are individuals that are seeing it. They're seeing it on prices received, but they also have to figure out how to recoup some of that cost. And this is why we expect margin pressure. We expect margin contraction, because it's not easy to pass on price. It's not like, oh, well, my prices went up here, so we're just going to raise prices over here. There's more structure behind it. Well, am I going to lose volume? Am I going to increase value? But is my increase in value going to be worth it? If I increase value by $1, am I going to lose enough volume to the point that the impact is going to be $1.50? So net, I'm actually going to lose money. So I'd rather just take the hit, maintain the volume, and sacrifice a bit on the margin. And these are where the pressure points are really going to impact, which is why when we look at the equity markets, where things sit right now, we're still obviously at near all-time highs. Obviously, we've had a small pullback, but again, it's been small, especially if you zoom out. These are some of those real problems that we don't think are truly appreciated when we're looking at earnings, when we're looking at impacts as we progress through not only the earnings season, coming up, but also what is the guidance for 2022? Because I think this indicates a much more cautious view, even though we are coming out of the pandemic. As we were saying off camera, it seems like everybody has COVID. People are testing positive that are doing it because they had to, due to travel or because of a close contact. They feel fine. They never got sick, but they were positive. So you're starting to see some of this, I think, ending. But what does that mean on the back end when we're looking at consumption? And here's some of those impacts. So consumer sentiment fell in early January as inflation and Omicron fears, grew. I think Omicron fears will moderate fairly quickly, especially as we get into the first week or two of February. But the expected change in inflation during the next 5 to 10 years is continuing to creep higher. It's still only at 3%, but you're getting an idea of just where the breadth is, where the pain is, and why we're seeing sentiment fall so much. A lot of that is due to inflation. Omicron plays a part, don't get me wrong, but it's the inflation and wage side that I think is the biggest impact to consumer sentiment, which does not go away as Omicron fears start to reside. And here's why. When you look at prices paid index, prices received index, both are still near record highs. But look at where the prices paid index is and how it's hanging out at the top, where prices received have come down a bit more. I just think that you're going to see that start to normalize a bit, but that distance between the two is where you lose that margin. That's where you get some of those, your costs have gone up, you can't pass all of it through, and that's the impact to earnings that I think we're going to have to start to get used to as we go through this earnings cycle and beyond, until we get a much bigger deflationary push, which would be where the consumer's like, look, I'm done. I can't spend anymore. I have to I have to cut volume. I have to go to some substitutes just because I can't afford this. And I think that's when you start to see one of those bigger moves down that would come towards the back end of the year. And just breaking it down into what is rising the most. So obviously gasoline, used car, and trucks, which so far the first 15 days of January, they're up again. So we're still seeing some of that pressure. But look at gas, utility pipe gas, meats, poultry, fish, to all items. So overall inflation hit 7% year on year. So when you look at food at home, electricity, food away from home, apparel, when was the last time a shirt was more expensive now than it was previously? That's where you're continuing to see some of these pressure points on the technology side, on the apparel side, on the electronic goods. Things that have been deflationary for so long are now inflationary and unlikely to go down, at least in the next 6 to 12 months. And that's where even if gasoline prices come down, if used car and truck prices come down, there's still a lot of pressure behind it, which again is keeping that stickiness and giving us that movement where, yes, we rocketed down, saw a huge increase on items and the breadth of inflation. And this just shows you the breadth where, yes, there are outliers. They'll fall back to the average, but the average is growing just based on where a lot of these things fall. Now, on the same side, the CTI Economic Surprise Index is now negative again. We had some underwhelming data, and this is where we're now starting to see some of these pressure points when we're starting to talk about global growth, U.S. economic growth, and especially GDP growth, as we're seeing some of those impacts coming through as estimates are being revised lower. And then all the while, we continue to see a push higher on the 10-year yield. And this is where, when we look at the 10-year yield, are we going to get an inverted yield curve, which is typically a precursor to a bigger drawdown on equities and realistically a potential recession, because it just means that people are trying to get. When you look at the inflationary adjustments, you're starting to get that flat line where either you're getting rates moving up, I should say yields moving up at the front end of the curve and being pressured down. And that's just because there's more of a look on longer term protection. this adjustment in inflation. And then typically, so you get a yield curve that either goes flat or inverted, and then you get a big snapback. And then that snapback is when you get, I think, one of those bigger drops in equities. But this is where we want to look at the bond market and rates. And this is what we have been saying. We said it back in February of last year that there was going to be a much bigger increase. We got the big increase. Then we kind of just went sideways at this point, and now we're starting up again. And it's here we have legs just because we don't have central bank protection. We don't have some of those fiscal stimulus. And why is that? Both of those have different meanings. So when you look at the monetary side, rates are going to get pushed up. You're starting to see quantitative easing coming down. You're getting tightening. That is going to, again, drive things higher. But then you had fiscal stimulus. Fiscal stimulus is also going to create that inflationary pressure because you have buying, you have pent-up demand, you have people now have more money to spend. So as those adjust, we should see, again, that inflation come down, but there's still a lot of ground for some of these yields to make up, which is why we do think we get to that that 2% fairly quickly over the next few weeks. And then when we look at the U.S. GDP economic forecast, you can see that big drop from where it was. And this is where we continue to see some of these pressure points that we've been highlighting, where it's not that we're going to go negative yet. It's not that we have a recession or a slowdown. It's more of a slowdown. It's where everything was running high, but it's like, guys, am I the only one looking around where, yes, there's the stock market and then there's the economy. And the economy is not really reflecting what is in the stock market right now, which is, I think, starting to kind of come through based on some of this data. Now, as we said before, we are seeing some of that move in terms of, not at all concerned into very concerned. You can see that it's fairly muted, especially when you look at somewhat concerned. People are like, yeah, it's a thing. I'm not going to go out there and lick a hand railing, or go out and just go crazy and drinking other people's drinks or licking other people's forks. But it's just take precautions. I mean, that's what I think that somewhat concerned is, which is why it's been fairly stable. It's like, look, COVID's here. It's not going anywhere. Is it an issue? Sure. If I had comorbidities, if family members do, got to take it a bit more seriously. But for the most part, you're starting to see that, maintain. Now, yes, you have some people that are now very concerned, and you can see kind of that going from not at all concerned to somewhat concerned, some of the people from somewhat concerned to very concerned. But for the most part, you could see how quickly it goes up and then how it can come back down. And that's something that we think will happen as we go through February. Now, when you look at the spread between CPI and PPI, it bounced slightly through December, but remains deeply negative at that negative 5.1%, coming back to what are companies paying versus what are they getting, and why there's some of that. They're going to try to push through pricing. I'm not saying they won't. But the moment they get a bigger hit on some of the pricing, some of the volume, that's where you'll see some of the reaction and some of that fear, which is why we look at prices paid, prices received in terms of where some of these movements are going to be on the debt side. But at the same time, this is where you're getting that hit to Michigan, to consumer confidence. So consumer sentiment, University of Michigan, some index fell to new cycle lows this January at negative, moving to 73.2 versus an expectation of 73.8. It's the lowest print in over a decade, to give you an idea on the fear that is residing through. And it's not Omicron. Like, there is... look at where we were when COVID first happened, when we knew nothing about COVID, when there was no vaccine, treatments were unknown, sentiment was higher than it is today. So if you think it's Omicron, it's so much more than that, which is something that we've been trying to get across. And this is also looking at, the average bank account balance by income. And where we continue to see on the pressure points, when you're looking at really 20 to that 60, that key area, you can see that it's still fairly low. And my wife yells at me because obviously it's a struggle building your own company, and we look at some of these individuals that live these lavish lifestyles, and I'm like, how do they do it? Like, I feel like we're very good with our money. We try everything that we can, and we're not doing, and it's just debt. It's people live paycheck to paycheck, and I'm always shocked when I see stuff like this. So when you look at what is in the bank, what is protected, what a lot of that spare capacity has already been pulled back into the market, as we said in the very first segment when we're looking at how energy prices drained a lot of that excess liquidity, again pulling that into on the inflation front. Then when you look at banks are easing lending standards. So all consumer loans, when you look at they're still remaining easy. They're getting a little bit tighter, but again, still on the easing front, still trying to push that credit through. But now people are starting to take them up on credit, and that's going to lead to some of that tightening because, again, we've seen that money come out of savings. We've seen that money start to normalize, which is, again, leading to the increase in spending index on the credit side. So this is looking at risk score quintile adjusted for inflation. You can see that we're back to borrowing at the levels that we've normally borrowed, and with the lowest quintile getting right back to those pre-COVID levels, just showing how, I guess, the U.S. is healing. We're back to borrowing to buy stuff that we don't need. And this just shows how aggressively we've gotten there. And just that big jump in consumer credit, and the U.S. consumer credit 1 month change back to the highs as we've seen earlier. So we're seeing some of that credit card debt getting taken up, some of those consumer loans going out, which is again going to lead to some of that tightening. And when you look at excess savings, have nearly reached that 2.7 trillion, but that's a cumulative excess savings. And if you look at monthly savings, we're now back to where we were in 2019. And as we showed earlier, it's very much weighted towards the 1%, the top 10%, and the older individuals, where people that need it the most may not have access to that cash. And so then when we look at wage trackers, here you can see the first quartile, which is the lowest earner, continues to surge higher. We're starting to see that fourth quartile flat line, which is something that we had been calling for. More of a flat line, not this big move up, as we're seeing some of this stabilizing when you look at the overall number getting a bit better. But this is not accounting for inflation, because then when we take this to real wages, it's still deeply negative, of negative 2%. So this is looking at nominal. They're trying to keep up, but as inflation continues to rise, you're not seeing wages keep pace, even though they're moving at a clip that we haven't seen since essentially 2014. So I should say 13 into 14. So, but you'll start to see that make up as inflation slows. But as inflation slows, we're also going to see wages slow a bit. So yes, I think real wages will go positive, but not to the same degree in which they went negative. So you're still going to have some of that loss of buying power that's going to remain in the system. And then when you look at why, well, U.S. PPI finished goods. Finished goods were 12.2% in December versus 13.3% in November. Pace slowed, but you're getting an idea of just that elevated level leading to the prices paid. What did the company pay for these assets, for these products? PPI monthly change in December PPI inflation was 0.2% and was softest since November 2020, which was at 0%. But again, it's just showing the pace is slowing, but you still have that elevated pricing, which then when you put it together on a year-over-year level, December PPI was at positive 9.7% versus the estimate of 9.8%. So you're seeing that core as well came in at 8.3% year-over-year versus the estimate of 8%. So core is continuing to tick higher. Again, that sticky inflation leading to some of those pressure points as you're starting to get kind of that cresting that we've been talking about, and some of that stagnant move and realistically a negative move as we go through January and February before we get that acceleration before a bigger downshift. And then when we round that out with the U.S. With expected change in prices during the next 5 years, here you can see that on the University of Michigan, that slow grind higher, but CPI urban consumers, that massive move up. And that's where it's not going to come down, and that's going to pull that expectation up, which is going to, again, weigh on consumption, where CPI inflation is increasing at its fastest annual rate since early 1980s, but consumers' expectations for inflation is next 5 to 10 years still low at 3.1%, not yet beyond 2008 levels, different from early 1980s when expectations were surging along CPI's rise. And there's still confidence that we're going to get this under control. There's a lot of supply chain issues. We obviously had a pandemic. So there is some truth in that. But as the stickiness in inflation bites and as wages don't really keep pace, that's when we think you're going to get that bigger increase and see that get move much closer to 4%. So then when you look at wider divergence between buying conditions for vehicles continue to be a massive negative, where things are starting to stabilize for homes. But as the 30-year comes, that 30-year mortgage is going to be the key on how well people view this and what are the expectations going through it. So this is going to be something to watch, because just looking at Nassau County, Newsday ran an article that over 14,000 homes are behind on their mortgage. So as the moratorium on evictions ends, how many people will be forced out of their homes? How many will be able to make payments? And that's going to be a big question as to how many fire sales are there. Does that increase volume, which then brings some of the prices down? And this is going to be something to watch, especially when we're looking at what is happening on the sentiment side. So now that we've gone through that, we want to go through, what is happening next when we talk about the Empire State numbers, when we're looking at Fed and some of the other real wages and spending side, because I think it's very important to look at, what are we seeing going forward, and then how is that going to impact GDP through Q1 and Q2 of this year.